Confirm whether you can hear me.
Yes, we can hear you.
Okay. So we are going to handle another standard that is all about IFRS 16, about leases. We are going to do different questions. But as usual, it is good to first have some background about the standard before we tackle any calculation number. Okay. So we are going to handle IFRS 16. That is about leases. It's an interesting standard. You just need to understand its dynamics. It is a bit common. It's a bit common in exams. So it is good for us to really know this standard. It replaced which standard? It replaced actually it replaced ISC, IAS 17, if you recall, and that was effective 1st January of 2019. That's when actually this standard came in. Okay. Lease is an arrangement in which the lessee acquires an asset from a lessor in return for rental payments. Rental payments means minimum lease payments, okay? Or call it consideration. Yeah, that's about lease. IFRS 16 states that a customer has the right to direct the use of what we call an identified asset if number one, he or she obtained substantially or the economic benefits from the use of an asset. If the customer can substantially obtain all the economic benefits from the use of an asset. If you use an asset, are you the ones going to receive money? That's what we are meaning. If you're the one, if you can actually be the one receiving the benefit from the use of an asset, then we can say that you have a direct control about that asset. Then number two, if the customer has the right to direct, he or she has the right to direct how and for what purpose. The asset is used throughout its throughout the lease term, throughout the lease term. So these are two conditions. For you to say that a customer has the right to direct the use of an asset, we must look at these two two conditions. Okay. In an exam, you need to know you are in the books of the lessor or lessee. You just need to know that. However, what is common is in the books of lessee. But sometimes they can ask you a question to actually talk about the accounting treatment in the books of lessor. Okay, so we are going to start with accounting for leases by lessee. Why basically do we need to talk about accounting for leases by lessee? You know that accounting looks at the control, okay? Accounting looks at the what? At the control. And in a situation where there is lease, obviously the one who is going to be controlling an asset is the lessee. Okay, so we need to know in the books of lessee, what are the accounting treatments that can happen. Okay. Before bringing in this standard, when we are handling IS 17, actually in the books of lessee, we could also be talking about what we call operating lease and finance lease. But because of this standard, IFRS 16, we no longer talk about operating lease separately and account and the finance lease separately. No. We only talk about operating lease and the finance lease separately when we are in the books of lessor. But in the books of lessee, we only aggregate, we don't separate. Okay, so you need to know that difference. Okay, so we need to know the initial recognition. Initial recognition. At the commencement of a lease, what will the lessee account in his books? Okay. So initially, okay, initially the lessee accounts for two elements. Okay. Who can recall these elements? Who can recall these elements? Initially, the lessee accounts for two elements or two items. One
is liability.
Pardon?
Lease liability.
Lease liability. Lease liability. And what? The right of use asset. Right of use asset. So those are two elements. You as a customer or you as a lessee, you need to account for these two elements initially. And the IFRS 16, that is about leases, requires require the lessee to initially measure, okay, to initially measure the resulting liability at PV, that is present value. Present value. And the right of use asset at cost. Okay, we need to note that initially with lease liability, we measure it at the present value. Then with right of use asset, we recognize it or we measure it at a cost. Is it clear, colleagues? So, what is the lease liability? What is actually lease liability? If you were to get initially, if you were to get the lease liability, because you cannot get present value when you don't actually know the lease liability. Are we together? So you need to first know the lease liability, and then you look for its present value. So lease liability is equal to a present value of what we call minimum lease payments. Then we add a present value of guaranteed residual value. Then you also add a present value of purchase price. I include everything here because in computations you may find that you have different items. Okay, and in a situation where you don't have, let's say, guaranteed residual value, in a situation where you don't have the purchase option, then these ones will be zero. Okay. Colleagues, MLP stands for minimum lease payment. What are you supposed to be paying every year? That is minimum lease payment. You have entered into an agreement. This is not your asset. Lessee has told you you must be paying me at least this amount of money every year, or at the beginning of the year or at the end of the year. You must be paying that lessee a certain amount of money. That is minimum lease payment. Okay, but as we get a liability, we look at its present value. Okay. Then what is guaranteed residual value? Because you may be wondering now, what is this? What's this? I think here the spelling is wrong. Here there is A. Granted residual value means what? I have given you I have given you a right to use my asset. You as a lessee, you as a customer, I have given you a right to use my asset. But I'm saying at the end of the lease term, you must pay me a certain amount of money. So since this guaranteed residue value is what the lessor is assured of after the end of the lease term. And it depends on the contract. It depends on the lease contract. Sometimes you may enter into a contract where this option is not there. But you may also enter into a contract where this option is there because of different circumstances. And you need to know why would actually a lessor say you pay me a certain amount of money at the end of lease term. Here we are not meaning minimum lease payment, no. There is a certain amount of money you can agree between the two, so that at the end you can actually. Yes, please.
Abel, do we have a question we are going to try out that has mistakes?
It depends on the question.
But they are so new to me. So I just wanted to know how we can apply such on a practical thing. Yes, because me, I knew the lease, we just get the lease liability, then the right of use, and then we do what? That last part where we get the current liability and the non-current liability.
No, this one is also there. This one is also there.
So that's
because
you
see,
to know how it is applied.
You see, yeah, that's why I'm trying to. You see, a liability normally happens because you have an obligation to pay in the future. Are we together? A liability happens because you have an obligation to pay in the future. One, you have at the end of the year or at the beginning of the year, you are paying what we call minimum lease payment. But there could be another obligation. Like you find that you entered into an agreement with you as a lessor, you entered into an agreement with the lessee or the customer, and you are saying that this customer should pay me a certain amount of money at the end of this. So,
yeah, but I feel like paying for them, I should be paying for them.
That money the customer will pay at the end of this period is what we call granted residue value. Practically, you will meet also these things. It's not all just passing exam. Practically, you may meet also these things. And why would we actually have a granted residue value? One, this customer is using your asset, okay? This customer is using your asset. You have no control as a lessor. What does that one mean to you as a lessor? It means that now you invested your money as a lessor or as the owner, and someone is taking control of your asset. By the time that person is bringing back the asset, you are saying that the value must have reduced. So because you invested to purchase an asset, you are putting an obligation, you are putting a liability to a customer in a way that I need to recover what I invested. So to recover what I invested, I will create in the contract, I will create this element. I will create this element of saying, okay, use my asset, be paying this minimum lease payment, but at the end also pay me certain amount of money. And also another thing may be you want to reduce the lease payment for the lessee. For you to, if minimum lease payment, let's say was assume it was 10 million every end of the year, and you are saying that at the end of the year, at the end of this payment, pay me a certain amount of money, let's say 8 million, let's say, let me say 5 million as residue, as granted residue value. So what does this one mean? It means that now, since you expect another amount of money at the end of this payment, at the end of this period, you are going to reduce this minimum lease payment so that the customer can have at least a relief. Okay. Also, another thing is to protect the lessor's interest. That's why you may need also to create this guaranteed residue value in the contract. You are protecting your what? Your interest as lessor. Because the value of an asset may reduce because of depreciation, because of, let's say, asset market value. By the time that customer is bringing back an asset, that asset is no longer at its original price. Okay, and because of what you predict, you say that by the time you bring back my asset, also make sure that you pay me some certain amount of money. You are protecting yourself. So colleagues, to you who are planning to do these things, these are the things you need to include in your contract. Okay, so that's all about guaranteed residue value. Saying at the end of this term, you must also pay me a certain amount of money. Because that money is coming in the future, that's why we are looking for the present value. Then what about purchase price? This purchase price comes in a situation where the lessee has a right to purchase that asset. If the lessee had the right, if that customer had the right to purchase that lease asset, then you may need to also get the PV of the purchase price. But of course, you look for you add this if you can actually tell what will be the purchase price. If you're not given purchase price in the question, don't add this. This one will be 0. So for you to add this, you must be having the purchase price. If the customer is to purchase the asset at the price will be at how much? If you have that price, then you need to get its present value. And this one normally comes in the year when the customer has exercised the purchase option. Colleagues, is it clear? Have you picked something?
Yes, Ade.
So you just needed to know the reason why you see in some questions they don't add all these things is because you may meet in a question that these things are not there. But what if the exam we are going to do, these items are there? If you have the purchase price, you need to know. Of course, for you to add here, you must be sure that the customer is going to exercise, and purchase what? The asset. So in which year? We will be asking ourselves in which year? Then you get the present value. Okay. So that's about lease liability. And this is initially. This is at initial recognition. Then right of use asset. Please, if there is a question, you need to ask. Of course, as you get PV of minimum lease payment, you need to know whether the payment is at the beginning of the year or at the end of the year, as we are going to see in some questions. Okay, and also the amount you're paying may be different. You may find that you are paying different amounts in each year as minimum lease payment. Sometimes you may find that you are paying same amount every year, or every end of the year, you are paying the same amount, or you are paying different amount. So you also need to know that. Okay, then what about right of use asset initially? What about right of use asset? Initial recognition. So, initial recognition for right of use asset, we just get the present value of lease liability, the one you have above. Then you add the initial deposit, add direct costs. Initial, here you add our word initial direct costs, then add the present value of dismantling cost. Dismantling costs, then less lease incentives. Asset. Present value of this liability, this is what you have above. Then initial deposit, what could be initial deposit here? Here you may be paying, this may be prepayment made by lessee to the lessor at the commencement of the lease. How much did you pay? You can deposit some money. You can deposit some money. And practically, in practice, you'll find that what you deposit may be actually refundable security deposit or non-refundable advance lease payment. The initial deposit. The initial deposit, colleagues, may be refundable or non-refundable. This is refundable. This is refundable security deposit. Then you may also have non-refundable advance lease payment. This non-refundable advance lease payment is like when you meet a question saying there is payment in advance. You are paying part of your minimum lease payment in advance. But if you read the question, colleagues, and you find that the initial deposit is refundable, colleagues, you don't add it here. You don't add it here. If the initial deposit is refundable, that will be treated as receivable. Are we together, colleagues? That will be treated as a receivable. Okay. You will not add it here. But if it is non-refundable, you add. That is like non-refundable is like part of what you are supposed to pay, you have paid in advance. Okay. But here you may give money to the lessor and say, okay, this is my deposit, but you will refund it to me. Okay. So in the question, you read it very well and see whether the initial deposit is refundable or non-refundable. If they are not If they are not open, then you take it as non-refundable and you add it here. Then what about initial direct costs? Initial direct costs, as you read the case study, initial direct costs may include what, colleagues?
Legal costs.
Legal costs. Of course, you need to incur this when you are drafting the lease contract. Legal fees. What else? What else? Only one. Anyway, any cost directly attributable to negotiating or arranging the lease, that will be a direct cost. Any initial cost you incur, as long as it is directly attributable to the lease, then you will include. Like now, talk about the commission you are going to pay to brokers. Commission paid to brokers. Remember, these are the ones that are going to help you to secure the lease. Okay. Costs related to credit checks or due diligence as you're trying to enter into lease agreement. You may try to search about maybe the what. Such a kind of costs are directly related to lease arrangement. Okay, so when you read the case study and you see you have some of these costs, you will add them here. Then dismantling costs. Of course, you are going to enter into a lease agreement, and maybe this is talk about the mining operations, maybe where they are operating. At the end of it, all they have to restore, to put back the asset the way they found it. So it is here. Here it looks at the future. At the end, at the end of this term, you must restore the asset to its original condition. Talk about these people leasing. If you lease a land or rooftops to install telecom towers, talk about antennas, satellites. At the end of it all, you need to remove everything and restore everything to its original position. Talk about the retailer leases. A retailer, you lease a store and you make significant fit outs, all like lightings, display, shelves, among others. At the end of it all, you have to remove all those things and you put the asset to its original position. But as here we are saying, you need to look for what? For the present value. Then lease incentives, you know them. Talk about reimbursement. If there is a reimbursement, if maybe you paid. And the colleagues' incentives can be in the form, it does not necessarily mean reimbursement. Talk about, let's say, rent-free period. You enter into an agreement maybe with the landlord, and the landlord says, okay, I'm giving you six months for free, then you start paying after. That is an incentive. So when you're doing a question, you need to know now each month, how much is what? How much is the rent? Then you look for the lease incentive. Okay, I know theory. When I talk about too much without calculation, you may start dozing. but it is good to know all these things because the questions may differ. But as long as you know the meaning of all these items, you can actually be in a position to answer. So that is all about initial recognition. Then subsequently, what do we do? Subsequently, lease liability should be amortized. Over the lease period. Okay, that is subsequently. Okay? This was initial recognition, but subsequently you should amortize. The lease liability should be amortized over the lease period. You should distribute the liability over the lease period. Okay. Then right of use asset should be depreciated over number one. Here we look at two things. Number one, over useful life. That is if the lease contains a purchase option. If the lease contains a purchase option, or at the end of the lease, there is transfer of ownership. So if you read the question and see that at the end of lease term there is purchase option, or the ownership will be transferred, then as you depreciate your right of use asset, you should use what? Useful life. Then number two, if there is no purchase option, then we look at the shorter of the lease period and useful life. The shorter. That is, if the lease does not contain, so we need it confirmed. We need to read the question carefully and see whether we have. So we need to read the question carefully and see whether we have, whether we are told that at the end there is transfer of ownership, or whether the question has a purchase option or not. If you find that they are silent, then you take the shorter. Why are we saying all this? Colleagues, useful life may be different from the lease period. You as a customer, you are going to use a leased asset for a period of, let's say, talk about 5 years. But it doesn't mean that at the end of 5 years, it doesn't mean that at the end of 5 years, that asset will no longer be there. It will still be there. You may find that the useful life of an asset is 10 years. Okay? So you need to know as you depreciate, am I going to use 5 years or 10 years? And these are the conditions we base on. Is it clear, colleagues? Because we are done with initially and subsequently. Okay, and this is all what we need to answer in a calculation question. But above all, we need to know when it expense lease payments, you as a customer or you as a lessee. Remember, these payments are same as minimum lease payments. Okay. So when should you expense? This standard actually allows an entity that is lessee to expense lease payment if number one, the lease payment is less than 1 year. The lease payment, if the lease payment, if the lease term is less than, if the lease term is less than 12 months, that is less than 1 year. If you read the question and confirm that actually the lease term is less than 1 year, we don't need to talk about money initial recognition, subsequently. You don't need to look at that, because you talk about initial recognition when you have an asset or a liability. But with an expense, you simply put that one under the minimum lease payment. What you pay to the lessor, you put it under expenses in your financial statement. Number two, if the lease is for a minor asset, such as furniture and fitting, talk about computers, among others. Colleagues, the standard doesn't actually define what is a minor asset, but to understand a minor asset, simply look at the lease. After the lease period, can you actually use again that asset? If you confirm this term, then that will be what? That will be a minor asset. Can only be a minor asset if after a lease period, that asset cannot be hired out to another lessee. Are we together, colleagues? If you confirm that that asset cannot be again hired to or hired out to another customer, then that is minor asset. And in such scenario, you are the first lessee, you just need to expense the payments you'll be making to the lessor. You don't need to create all these things, a liability and an asset. Look at the computer. By the time this period is done, you cannot again hire out that computer to another person. Okay, that is another theory. Then lastly, maybe the last theory I can talk about here is when should the lessee remeasure? When should the lessee remeasure a lease liability? Because colleagues, we said subsequently lease liability should be amortized over what? Over a lease period. But we have a situation where you will need to remeasure your liability. And you can remeasure, you as a lessee, you are the customer, you can remeasure a liability if there is one, number one, if there is what? If there is let me see, if there is a lease modification, okay, which arises I think I have started it wrongly, but if there is LSC measures, okay, let me just remove these ones. You as LSC, you can remeasure your liability if there is number one, if there is one change in minimum lease payments. If there is change in minimum lease payments, you were paying, let's say initially you were paying 10 million at the end of every year. But you realize that going forward, you are supposed to pay, let's say, 8 million. Here you will need to remeasure the lease liability. Okay. And then number two, if there is change in lease period. If there is change in lease, period. Initially, the lease period assumed that it was 5 years, and now you renegotiate. There is a renegotiated, and now the lease period is, let's say, 8 years. They added you more 3 years, from 5 to 8. In such scenario, you will need to remeasure a lease liability. But you need to know that the first lease period is what we call primary. Then the new lease period is secondary. Secondary period. you can choose to exercise or not exercise here, to extend or not to extend. That is, but here the first lease period, you have no option. You have no option. Here you have to meet the criteria that were set in the first contract. Okay. Then number 3, I have colleagues who want to try. This should not be one-man person. Who want to try? What is the next condition? Solomon.
I'm not conversant with this standard.
Jane. Okay, we can remeasure lease liability if there is change, in the interest rate implicit in the lease. Initially, assume that initially the interest rate was 10%, and now the interest rate is 12% or 8%. Then you will need to remeasure the lease liability. Okay. Then next. If there is sick, if there is C, okay, if there is C chooses to exercise the secondary period of the lease. Yeah. Among others, I think those ones are enough. If they ask us to give highlight about this. Okay. If I have any other. Those are the ones that are common. Here, this one may number 4. It can also, you may meet when they say when there is change in assessment of purchase option. Here, if there is a change in assessment of purchase option, it means the same here. Okay, so that's all about the theory. That's all about the theory. So we can handle some numbers. Now, if there is change, if there is any change here, if you read the case study and you see that actually in the question there is some change here, you will need to measure. You will need to do more. Maybe you can also get another question that has some of this. Okay, so let's start. Handle some calculations. First calculation we need to know when the payment is made in arrears. So for calculations, we need to know this. Number one, when payment is made in arrears. Number two, when payment is made in advance. Okay. Then number three, when there is a need to remeasure the lease liability. So that's where the calculation number can appear. That's just, you needed to know all these areas, okay? And you need to know you are in the books of who? Are you in the books of lessor or you are in the books of lessee? Okay. So let's see. I sent the guide. We are going to start with March 2022. Question 3. March 2022, question 3. Note number what? Note number 2. You read it through. 6 marks. You read it through. They are telling us that SUL entered into a lease agreement on 1st July 2018 under the terms of lease. Okay. This company entered into a lease agreement on 1st July 2018. Under the lease, under the terms of lease, SUL was provided with a machine for a period of 5 years. It's not your machine. In exchange for annual lease payments. Annual lease, annual meaning that you have to pay that amount of money, 100 million, which are due at the end of each year. This is very key. At the end of lease term, are you seeing that? At the end of lease term, we need to know, remember, we need to know whether there is the transfer of ownership or the purchase option. They are telling us that at the end of this term, the possession of the machine would revert to the lessor, and its ownership does not transfer to SUL. So colleagues, do we have a transfer of ownership here? No.
No.
Here we have no transfer of ownership. So it means that what are you going to use as you depreciate your asset? We are going to use the shorter. Okay. Okay. The shorter between the lease term and the useful life of an asset. Okay, and if you don't have the useful life of an asset, then still you consider the lease term. Okay. The interest rate implicit in the lease is 8%. No accounting entries had been made in relation to the lease. The machine is to be depreciated on a straight-line basis over the 5 years. Yeah, here it is clear, but in some scenario you may meet it is different. Okay, so we need to know. We need to see how we can account for. We need to see how we can account for this. So how do you start? How do you start?
Start by computing the lease liability.
You just simply start. Eh?
No,
We are required to write a report to Director of Finance, advising on the accounting treatment of the above transactions in SUL's financial statement for the year ended 30th June 2019 in accordance with relevant standards. So you simply start computing.
you talk about the standard.
You start and we see.
Ah.
I take it to you.
The other first part that you were telling us, the first part that we started on, how you understand the lease, and then you do the initial and then the subsequent. You talk about the initial recognition and then you talk about the subsequent recognition.
Okay, that is true. That is true. Okay. So this is the March 2022. Question what? Question 3, not, is it not 2, not what? Not 2, eh? Okay. So if we are to write a report, how do we write a report? We are writing a report to finance, to the Director of Finance, but we are writing this report as who? This company, okay. However, the director is concerned about appropriate treatment and he has sought your advice. So you are writing this as advisor.
Or consultant,
at this point,
student.
At this point, you are a CPA student.
Student.
Since it is not clear, since the title is not clear, at this point we are just CPA students, okay? So the report we can say to director finance of which company? SUL. Then we are saying from who? CPA student, since the title is not clear. As a must, we will need to do this in an exam. We will have somewhere to write this. Date we put what? The exam date. Our exam date. Do you recall? Do you know that it is on 2nd? 2nd December. 2nd December 2024. Okay. Then the subject now. The subject. Colleagues here we don't need to put exam date. We put the exact date. The subject now. The subject. How do we write the subject? We go to the required part. What are we told to do? Accounting treatment. Okay. Here, accounting treatment of the above transactions. Okay. So I can say accounting treatment. Accounting treatment of we have how many notes? Notes It depends on the notes I'm handling. If it is from 1 to 4, how many notes now in this part? We are from 1 to 5. So that's what I can put here. Okay, 1 to 5. You bring in some little introduction. Introduction, eh? How do you start? I have been engaged to offer advice on the accounting treatment of 5 transactions in the financial statement of SUL for the year ended. You put. I have been engaged to offer advice on accounting treatment of 5 transactions in the financial statement of this company. For the year ended, I put the year. A year is ending on which date? For the year ended the 30th June 2019. For the year ended the 30th June 2019. The advice is provided below. There we are, Nakamak. Now you start with the note you want. We are handling note number what? Note number 2, which is about lease of a machine. Remember, in an exam, now this is our first page. Now, first page, you leave a space here. You go to maybe to the next page and do your appendix. Okay. But here you need to write some essay here. Okay. The essay you are writing here is about the standard. Leasing, you bring all those things. Leasing creates, leasing creates lease liability. Lease liability and the right of use asset in the books of zoo. Okay. IFRS 16. That is about leases because they didn't specify the standard. So yeah, we needed to bring the standard. IFRS 16, which is about leases, requires the lessee, okay, the lessee to initially measure. Now here you know. Initially measure the resulting liability at, we say that what? Initially we said that we recognize We recognize lease liability at what? At its present value. And the right of use asset at cost. As per, now you show the where the working is. As per, as per appendix number, depending on your number. So this is our number 1, or depending on working. Here you can put working 1. So it means that now you will go to the next page and do your appendix. So that is the first, initially. Okay. Of course, here we will need to also bring in the double entries, because section B, it's all about reporting. It's all about real reporting. You have to talk about everything. The initial, the initial entries required to recognize the lease are the initial entries. Remember initial entries. Now, we have said that this leasing is going to create lease liability and right of use assets. So what are entries now? What are the entries you're going to pass? It will depend on your appendix. It will depend on your appendix. But obviously here you need 2 things. You need a lease liability. So it means that a liability is an asset. You normally know that it is debited. So you will debit your right of use asset with the amount you will calculate. Then the amount you get, then you credit the lease liability with the amount from the question. Okay, that is number 1. So this one, the amount, we are going to put the amount after calculating. So after that, subsequently, what are we supposed to do? Subsequently, lease liability should be amortized. We said that should be amortized over for this question. For this question is what? Over what? Of course, a liability as a must, it is based on the lease period as a must. Lease liability should be amortized over the lease liability, because after the should be amortized over the lease period, because after the lease period you will not be having any other obligation. That's why we base on the what? On the lease period. Lease liability should be amortized over the lease period, and the right of use asset should be depreciated over what? For this question, since there is no purchase option, or since there is no transfer of ownership, automatically the right of use asset should be depreciated over the lease period, which is 5 years. Okay. That is subsequently. Then you tell the examiner that refer to refer to another appendix because you will need to show these workings, how you are amortizing, how you are depreciating. So refer to our appendix C. Appendix C. Can be appendix what? Appendix still 1, because it will be the one talking about this liability. Okay. So where you are referring the marker that it is appendix 1, it's just the workings, but you will need to leave maybe space. The space you're leaving here is to how you are going to recognize in the financial statement. But I know that when I'm handling a lease question, I know things that I should do. By now, I know things that I should recognize in the financial statements. So for me, immediately I do this. I say that for the year, before I even go to the workings, I say that for the year ended, our year is ending 30th June, 30th June 2020, what? 2019. 30th June 20, but here it is 2024. And you know this is exam date, okay? This is exam date. This is exam date. Okay. For the year ended the 30th June 2019, this company, this lessee should recognize the following in their financial statement. Number one, may I know that I will have right of use asset, and it should be recorded at its carrying value of shillings. Now here I leave the space. That's to me because I have been doing these numbers. May I know now I am used as the right of use asset at its carrying value of shillings. I leave a space. As a non-current asset in its statement of financial position. That is number one. So if you have right of use assets, it should be recognized at its carrying value in this as a non-current asset in the balance sheet. Then next, what you have is depreciation during the year. Depreciation expense of shillings. I leave a space of shilling this as an operating expense in its profit or loss account. Okay, that is next. Then the next item you will need as you do this is interest cost. Since there is a liability, you need to pay an interest. Interest cost of shillings, I leave a space. Of shillings, I leave a space. Then I say as a finance cost in, remember a finance cost is in the profit, in the PL, profit or loss account. Okay, Then the next, here, colleagues, as you're handling a question about lease, know that you have 5 items. Sorry, colleagues, about the network. Are you in a position to hear me now?
Yes, you are clear.
Okay. Okay, where are we? This is liability you are talking about here. Know that it should be split into 2. This is liability of sharing that should be split in 2. You will have a current liability and a non-current liability. Should be split in 2 non-current liability of shillings. We are going to find out how much, and the current liability of shillings. I will find out. So know that you will have a lease liability, yes, but it should be split into 2: non-current liability and current liability. Then the last item, because I said we have 5, the last item is the one that we report in cash flow statement, and that is minimum lease payment. Okay, minimum lease payment of minimum lease payments of shillings. This one is even given direct before we compute. Don't we have that? What you are supposed to pay? Annual lease payment, shillings 100 million. This is that's what you record. Minimum lease payment of shillings 100 million. As a cash flow, towards the financing activities in the statement of cash. So colleagues, these are the only items that we record. 5, they are easy to record. You know that if you're talking about an asset, there is an asset and depreciation. If you're talking about liability, obviously there must be a liability and the interest you're paying. And obviously because I got a loan to finance my activities, then in the cash flow statement, you'll have this minimum lease payment. So these are the only items, as long as you're handling a question about lease and you are to report. These are the only items. Okay. So for us, our role now is to compute and fill in the gaps. So Appendix 1. So we need it start with initially. Initially, how do we get this liability? You have the formula now. This liability, we have the formula. Very well. Okay, this is our formula. This is our formula. Okay. So you handle one by one separately. You handle, because in the question we don't have residue value, we don't have granted residue value, we don't have, and colleagues, this granted residue value is different from residue value. Look at residue value as scrap, but this granted residue value is not scrap. It's just a minimum amount you can pay to a lessor based on the contract. You entered into an agreement with the lessor and you agree that at the end of this period, I must pay the lessor this amount of money. That is guaranteed residue value. We are calling it residue value because it comes in at the end of the what? At the end of the lease period. But this is not scrap. Then this one, I said it can be there only and only if you can tell the amount of the purchase price. If there is purchase option, then what is the purchase price? If you can see the purchase price, then look for its present value. Okay. But in this question, we only have minimum lease payments. So we look for its present value. And since it is only, we need to know, is it at the beginning of the year or at the end of the year? It's at the end of the year. So this is like payment in arrears. If it is at the end of each year. So how do you get minimum lease payment? I can put here, the period, yes, then I put here minimum lease payment, then I put here discount factor. Discount factor is at what is the rate in the question? The rate given is 8%. At 8%. Then I need the present value. Since we don't have different amounts in the question, since this lessee is paying the same amount every year, at the end of every year you're paying this amount is not changing, then we can use the annuity factor. But if you're paying different amounts, if each year you are paying different amounts, then you use the single factor. So here with annuity, I say 1 to 5. Every year I'm paying. One to 5. Every year we are paying every year 100 million. So let me work in. Let me put my figures in shillings. But I can decide to not to put. It depends on an exam. I normally keep some 3 zeros to help me with time. Every time, because every time you're writing a 0, there is a second going. So we are paying 100 million. Okay. What is the discount? What is the discount factor? Remember, this is annuity. If you're looking at more than 1 year, same amount of money every year, you use annuity. And in the question, they normally give us the table.
30.993.
You know how to read the table? The question. We are handling. So we are handling match. In the table, it is how much, it is what rate. Here you have present value. We have present values. When you see this part, 1 plus r power negative n, this is for a single factor. We are looking at only 1 year. When you're looking at only 1 year, use this table. Then if you're looking at more than 1 year, that is annuity. You use this. Even the formula is given. You don't want to read. So we are handling how many years? 5. 5 is here. At what rate? 8%. All of you, do you have this? 3.9. I don't know if I'm copying the right thing. So finally, what is my present value? Get this times. Okay, so that is my answer. That is my present value. Then what about right of use asset? The formula I have. Let's put some speed. Right of use asset, this is the formula. This is the formula. So we ask ourselves, based on this formula, what do we have? We have, in the question, we have already now, we have the present value of lease liability, 399 million. Okay, plus, do we have initial deposit? In the question, I didn't see any initial deposit. Plus, do we have direct costs? Do you pay any money in arranging for lease agreement? Do we pay any money? Nothing. We have nothing. So everything is 0, 0, 0. Okay, here everything is 0 plus 0 plus 0 minus 0. Okay. So finally, your right of use asset is also this figure. So you go back here and write your amounts. This is shillings. 3,993 million. Good. 399,300,000. Okay, that is my first part. Then the same here. Colleagues, are you picking?
Yes.
Okay, so that is initial. Then subsequently, we have to amortize lease liability. We have to amortize lease liability. But before we amortize the lease liability, let's first handle the right of use asset because it is easier. We first depreciate. Depreciation of right of use asset is equal to the cost of this term. That's what we stated. So here the cost is of how much? What is the cost? Right of use asset is how much? It is this one. So that is the cost. Then we divide by 5. Okay. So what do we get? Divided by 5. That's the depreciation. That is the depreciation per what? This is the depreciation per year. Okay. Then once you get your depreciation, ask yourself, now what is the carrying value of right of use asset? It will be equal to what? How do you get right of use asset? You get the cost. The cost minus what? Accumulated depreciation. So here the cost is equal to how much? The cost is equal to how much? The cost, the right of use asset is 399, 300,000 minus open bracket. The depreciation for each year is 79,860. Then times how many years? You have used this asset for how many years? From the time you entered into an agreement up to the reporting period. How many years? Count. From 1st July 2018 to 30th June 2019. That is only 1 year, I think. Isn't it? Times 1 year. So the answer is what? I get this minus depreciation. So that is my carrying value. I record. I record this figure where you have carrying value. Somewhere. Where? Okay, right. Okay, it is here. So I'm going to record. What is my right of use asset? Rather 319.4. So I record here 31. Tell me what it is. 31 what? 319.
319, 440,000.
Perfect. That's what I record. Then I also record the depreciation. The depreciation, our depreciation is how much? 979.
860.
Okay, that's what we record. So it means that we are left with lease liability, interest, and only lease liability and interest. So we amortize now. Lease liability should be amortized. Okay. Should be amortized. So we draw our amortization. Should be amortized over. You add that word. Amortization schedule for lease liability. Okay. I will need to create here. Yes, I create balance block forward. I create column for interest at 8%. Then I create column for minimum lease payments. Then lastly, I create column for balance carried down. That's if you're handling a question that has payment in arrears. If you're handling a question with payment in advance, this table will change. So here it is shillings. Okay. You don't need to put all years. So here I can put year 1, year 2. Okay, use you in a question in an exam. Let's use it is good to use the exact. The first year is 2019. The next year should be the first year will end in 2019. Then the next year will end in 2020. And we are reporting in what? Colleagues, we are reporting in 2019. So I don't need to include up to 5 years. No. Just need to know when is your reporting period, then add 1 year. That's enough. Our reporting period is 2019. I add another 1 year. Full stop. Okay. So balance brought forward, that is the lease liability. What is your lease liability? The present is this one, okay? That is our lease liability. How do you get interest? 8% times this. Our minimum lease payment you have, which is 100. Put it in a bracket. It's a negative. You have to pay. Okay. Then how do you get balance carried down? You get your balance brought forward, add interest, then subtract minimum lease payment. To get balance carried down, you get balance brought forward, add interest, subtract minimum lease payments. So the balance carried down of the previous year is the balance brought down of the current year. Okay, you do the same here. 8% times this. This one will be the same. This one minimum lease payment. Remember, you have to keep on every year. You have every end of the year you are paying 100 million. So this one must remain constant. So here you get this figure plus the interest, then minus minimum lease payment. You stop there. So we need the we needed to know what is the lease liability for this current year. Remember, we said that this lease liability should be amortized. You're looking for the liability for each reporting period. That's why you are preparing, amortization schedule. So it means that as we are handling the year ending 30th June 2019, the only liability we should recognize in 2019 is this one. That is the liability we should recognize in 2019. So I come back here where we have the lease liability of shillings. I record that figure, which is how much? 331 244 thousand. Okay. And this lease liability should be split into two. So we need to know what is non-current liability and what is non-current liability is the liability of the next year. This is the non-current liability. That's if you are handling payment in arrears. The non-current liability is for the next year. Then current liability is the difference. The difference between the lease, this one minus this one. And that's all. So you go back and report. Here, non-current liability, we are saying it is 257,744. Okay. Then lease liability is of how much? Rather current liability. 73,500. That's what we have. So here to get current liability, you get the difference between this and this one. Then long-term liability or non-current liability is the liability of the next period. So colleagues, that's all about this. We have done everything. Okay, any question? If the payment is made in advance, what do you do?
We start from year 0.
So we are handling that note. They are telling us that on 1st July 2018, MIA entered into a contract to use the 3 wagons belonging to Prompt Railway Limited to deliver its export products and imports to and from Mombasa at annual cost of this payable in advance. Are you seeing that? Payable in advance each year. This is like payment at the beginning of the year. Payable in advance. This is annual cost, but payable in advance for 5 years. The wagons are used exclusively by this company and kept at its premises when they are not being used. So it means that they have a right to control. This MIL paid legal fees are 370 million to Ginger Associated Lawyers to arrange the transaction. So that is part of direct cost. But this company agreed to reimburse and paid this PLO, this is the lessor, reimbursed 100 million towards the cost of transaction. So you know this is like lease incentive. The present value of minimum lease payments is this. Colleagues, never make a mistake and rely on the minimum lease payment given by the examiner. Sometimes it is wrong. Sometimes it is wrong and they combine other things. So for you, when you look at the mere looking, you will see that it is PV of the lease liability, minimum lease payment, but this is wrong. You need to compute. You have the interest, so you see you have everything. you need it simply put initially. Initially, we bring okay, that is initial. So we don't have residue value, we don't have purchase price. Only what we have is minimum lease payment. But this is payment. This is minimum lease payment is made in advance. So create here, not waste time. Going back here. Here we are handling from how many years? What is our lease period? Our lease period is for 8 years, okay? 8 years. Colleagues, are you still on?
Yes.
One up to what? One up to 8. No. Because here we are handling the we are handling the
Are we doing arrears or advance?
we are handling in advance. In advance. In advance, we reduce by 1 year. So the better way, okay, you can use the table, but the table will take time.
Do 1 to 7.
Okay. That's what you use, 1 to 7. Okay. Okay. 1 to 7. We reduce by 1 year. We reduce by 1 year, 1 to 7. Okay, since we are handling, but this is not good way.
Yeah, I think
You
the long
rather,
way better. The long way I think is better.
yeah, wrong way is better, but it takes time. But saying 1 to 7 is also,
Especially on the what? On the advance.
but it is okay. It is okay. Let's just, but the percentage rate is 8 or 5. So the minimum lease payments, but annual cost of payable in advance each year. So 1.85 billion. 1.85 billion. If you keep 3 zeros, you will be working in millions. Fine. Can bring everything. Okay. Then the discount factor. This is annuity. But colleagues, are we doing the right things? Is it 7? Oh, how many years?
That's what I was going to ask. Like, how many years do? Let me see. Contract from 2018. What is the year that we are reporting in which year?
Let me see. The payable in advance for a period of 5 years. So here it should be 1-4. Huh? Stato?
1 to 3. 5 years, yes. 1 to 4.
1-4. Okay. So when you go to your table, mm, 4 years here, then the rate is 5. Annuity, we are using the annuity table. 4 is here, 5 is here. Okay, so I put that in here. Finally, I get my present value this time. Yeah, that's what I have. So you see, colleagues, this figure, this present value of lease liability is different from the present value given in the question. The present value given in the question is what? 8.401. 8.4. It means that for them they considered also what? Also other things, 1.85, which was paid in year 0, which is wrong. Okay. Because if you get this figure and you add 1.85 billion, you get what they have. Remember, if you pay, you have no any other liability. That's basically why we are not putting. That's why we are not putting 1 to 5. The payment started from year 0, and we cannot put year 0 here. Okay, that is minimum lease payment. Then what about right of use asset? Right of use asset is equal to, it is not equal since we have lease. Minimum. Okay. So what is our, I'm going to get this, since I have present value of lease liability at 6.5 billion. I add do we have direct deposit? Do we have initial deposit? The initial deposit. The initial deposit, colleagues, is the payment made in advance. Remember here what I said, the way I defined the initial deposit. Do you recall? I defined the initial deposit somewhere. Non-refundable advance lease payments. So the person made payments in advance. So in year 0. So that's the initial deposit. And that initial deposit is of how much? 1.80 5. Then plus plus what, colleagues? Plus direct cost. We have legal fees in the question. And legal fees is of how much? Legal fees is of how much? This is our direct cost. 370 million. 370 million. We don't have dismantling cost, 0 minus lease incentives. In the question, lease incentives are how much? Reimbursed and paid 100 million. So incentive is 100 million. What do you get? 8 point, my God. Okay, that's what I have. But use your calculator and see whether that's what you have.
There is 100.
Finally, pardon?
There's 100 in between.
There is 100 between.
Yes, 80 then 100.
80, then 100.
No, it is 801.
801, like this, eh?
No, the figure is 86801.
86801. Okay. It is like this, eh?
Yes.
86. 86. There is another 8.
No, it's like that.
Okay, okay. Let me hope you added the very well.
No, I think 10 is not there. They have added many zeros.
Okay, like this, eh?
Yes.
Okay. Then we do subsequently. Subsequently. We depreciate right of use asset, depreciation of right of use asset is equal to the cost divided by useful life. Or there is an option to purchase. If there is option to purchase, then we use sorry colleagues. Here, over is term. Right, depreciation of right of use asset is equal to cost over is term. Since there is no option to purchase, we use the shorter. So the cost is this one divided by there is term 5 years. That's the depreciation per year. Then what is the carrying value of right of use asset? Is equal to the cost minus accumulated depreciation. And the cost is of how much? The cost is this one. Okay, I'm going to write 88680. 100,000. Minus what, colleagues? Minus, I open a bracket, the depreciation is 1,736,000,000 20,000. Okay. Then it times how many years from the time you entered into a lease agreement up to the reporting period. From the time you entered into a lease agreement, the lease agreement is on 1st July 2018. The reporting period is 30th June 2020. So how many years? So 2019 and 2020. So those are 2 years. Times 2 years. Okay. So this will be equal to, I get my right of use asset minus open bracket, the depreciation times 2. That's what I have as my carrying value. You will need to report that. So next, amortize. Lease liability should be amortized. This liability should be amortized, so we draw our amortization schedule. But this time it will change, so you note the difference. This is our template when we are doing amortization schedule for lease liability in a situation where payments are made in advance. So you will need to start with the year. The first year of the agreement is going to end on 2019. Remember our reporting period is 2020. So I put 2020, I add another 1 year. Okay. Colleagues, if you need it when you're putting years, make sure that you follow the order from the lease agreement up to the reporting period, then add 1 year. So what is the balance brought down for lease liability? It is this. A minimum lease payment. Minimum lease payment is of how much? At the beginning of the year, this company pays how much? 1.85. But since it is payment made in advance, it means that in 2019 here you will put 0. It was paid in year 0. That payment was paid in year 0. We don't put year 0 here. So you need to indicate here that it is 0. So it means that when you're dealing with this number, and the payment is made in advance, here the first year put 0, where you have a minimum lease payments. When you're getting subtotal, you get your balance brought down, then subtract minimum lease payment. Then interest 5% times the subtotal. Then to get balance carried down, you get your subtotal plus the interest. Okay. Then in 2020, it will be the balance carried down. Now the minimum lease payment will start from here. You put the minimum lease payment of 1.85, 1,850. But remember, this is in billion. Put this one in bracket. So subtotal, it's this minus the minimum lease payment. Here you get your 5%. You multiply by subtotal. Colleagues, are you getting? Solomon and Andrew, are you on?
Yes, I'm on.
Then balance carried down, you get the subtotal plus interest. Remember, this is our reporting period. Okay, so we add another final year. We don't need it to compute up to the last year. Just after reporting period, add 1 year. So minimum lease payment will remain the same. Then subtotal, you get the balance carried down, rather balance brought down. Then subtract minimum lease payment, the interest 5% times the subtotal. Then here you add this one plus this one. Okay, so once you reach here, the question will be, what is your non-current liability? Okay, the question will be, what is your liability in 2020? And out of this liability, what is your non-current liability? What is your current liability? And when you're handling payments made in advance, there is liability, of course, for 2020 in this one. That is the balance carried down. But the non-current liability, you need to pay attention here. What is our non-current liability? The current liability is the minimum lease payment. That is number 1. The current liability is what you are supposed to pay next year. This one. That will be. Okay, that is number one. Then non-current liability. Simply know that this non-current liability is the subtotal of the next year following the reporting period. It is actually this one. Solomon, is it clear?
When you add that non-current liability and liabilities, does it mean that it should give you the lease liability?
Yes. If you get
Uh-huh.
this plus this, it should give you the lease liability.
Okay.
Are you seeing that?
Okay, good.
So this is like the subtotal. This is like the subtotal. Subtotal of next year. Subtotal after reporting period. So that's all. This one you're reporting the financial statement in the balance sheet. Then in the statement of cash flows, you report the minimum lease payment of 1.85. And that's all. So colleagues,
Okay.
I think that's enough for now.